Hi everybody, I'm here to talk to you about contrarian investing. Um, the only way, or the best way to make money in the stock market is to be a contrarian. Because if you're going to jump on the bandwagon when everyone else is, you're going to have average returns. It's just like if you're going to sell when everyone else is, you're going to be costing yourself money. This is why actively managed funds are losing money to passively managed funds, like ETFs, exchange traded funds, because the majority of these money managers don't really know what they're doing. They think they might have one lucky streak and then they think they're God. But the reality is the majority of money managers out there don't know what they're doing. But being a contrarian, it takes a little guts because you're buying into a company as the stock takes a beating. The trick is to buy into one that the company is going to be around for the long term. So I've been studying the markets for over 2 decades, and always follow companies that are really big, strong companies with billions of dollars in the bank. Their current assets are much higher than their current liabilities. They've got a good long term. Mostly blue chips is what I like, but of course there's others as well. But you buy into the company when something happens that's negative and it causes people to sell the stock. That's, to me, is a really great buying opportunity. Troubled times are buying opportunities, and so I've followed hundreds of stocks and would follow it daily, and when I notice one take a huge drop, then I kind of do an investigation, see what happened, and usually it's a temporary problem in the company, but again, it's a buying opportunity, so you want to jump on buy. And now another trick is when you do make a purchase into a company stock, you don't buy your entire stake that you want to, if it's going to be $20,000, you don't spend all that money at one price. You buy just a portion, and that way if it continues to go down, you can follow it down to its bottom, because there is a bottom. The only way there is not a bottom is if the company is going to go out of business. So if you're doing this with really good, strong companies, you will hit a bottom, and you want to follow it to the bottom. Keep that average price per share down, because if you do follow it to the bottom, eventually when it does turn around and then people start jumping on, you're already in there, so you're going to reap the rewards of everyone else jumping onto the bandwagon. So, for example, let's say you have $100,000, and I would never put more than 1/5 of your money into one stock at a time. So that would be no more than $20,000 of this 100 grand. Let's say you're following a company, let's say it's Intel, and their stock takes a beating for some reason, and let's say it's $20 a share. I wouldn't put more than 10% of that into that first purchase. So if it's $20 a share, you're going to buy 100 shares for $2,000. That's 100 shares. Now, let's say it falls down to $18 a share. $18 a share. You're gonna still buy. This time you're gonna buy 110 shares. As you do buy the shares, blocks of shares, as the price goes down, the amount of shares you do buy goes up. So, if you're going to buy 110 shares at 18, it's going to be $1,980. $1,980 invested at $18 a share, because you bought 110 shares. And now for some reason, let's say it goes down to $16.50. And this time you're going to buy 120 shares. So 1650 times 120 is going to, that's also $1,980. So then you're going to have, that's going to be a total of $5,960. Okay, so you've bought 330 shares, and for a total cost of $5,960. Now let's say the shares just go back up to the original price you started purchasing at. You're gonna have, that's gonna be $6,600. So see, you're already in the profit margin of $640 when it goes back up to the original price. So, and you know it's going to go back up. When it hits bottom, it's not going to stay at bottom. Bottom is when there are absolutely no more sellers to sell the stock. So then it starts turning around, then you start getting buyers and more buyers and more buyers. So the bottom is the bottom, but it doesn't stay at the bottom. There's going to be a rebound. So, and you'll take advantage. You can't take advantage of the rebound unless you follow the stock to its bottom. If you didn't make these other two purchases and you made all your purchases at the $20 level and it rebounds to 20, you've made no money. So you've got to follow it down. Again though, most active money managers, you're not going to hear them say that because they, again, don't know what they're doing. They think they do, but the majority of them lag behind the benchmarks like the S&P 500 and the Dow Jones because they, again, don't know what they're doing. If you're going to make money in the stock market, you have to be a contrarian, and this is the only way to beat the benchmarks. So follow me on Investopedia, the website called Investopedia. You look up my name, Mario Lorenz, and you will find me there. And you have to start an account, but you can. I have a virtual portfolio there, and you can follow me there. So, thanks. That's it for now, and I'll talk to you later.